You know what's going to happen next week? Neither do I. So what happens when the unexpected happens? Learn the importance of planning ahead. Then everyone should have a TFSA. Find out why. And curious about when you should start taking your CPP benefits? All this and more on The Wealthy Life. What does the acronym TFSA stand for?
Tax-free savings account?
No, I don't know.
Tax-free savings account.
Today's guest is Franco Papalia, a financial advisor with some sound advice on the importance of planning for the unexpected life events. Welcome, Franco.
Thank you, Sybil.
You help clients plan for life's unexpected events. How did you get into the financial industry?
Well, I grew up in Vancouver, in the city of Vancouver, and at the age of 19, I managed to get a job at the Vancouver Stock Exchange.
Like buy, sell, that kind of stuff?
I started as a floor trader. It was quite exciting. For a 19-year-old kid, it was just something else. Fabulous way to start your career. I've been in the financial services industry ever since for the past 40 years.
Oh, wow. So you graduated from the trading floor into financial advising, a more grown-up thing to do. Less stressful, I bet. I don't know how those guys do it on the floor.
It's actually a lot of fun.
I'd like to know a little bit about one of the clients that you work with. I understand you have a case study to share with us today. Tell us about that.
Yes. I was introduced to a family about 20 years ago. Regular family with 3 young children. The wife, we'll call her Susan.
Yep.
Susan worked as a government worker with a great government pension. The husband was a 50-50 business owner with his partner, and he worked in the business full-time.
So happy family, all is great.
Yes.
What were they looking for?
Well, as their financial advisors, we started out by putting a financial plan in place, and the purpose of the plan was to identify issues that they needed to deal with. 3 of the main issues that popped up, one was just a glaring issue. There was no will in place.
Yikes.
Number 2, there was no buy-sell agreement in place for the business.
Double yikes.
Yeah, so if anything happened to anyone in the business, there was no rationale for how to exit the business. And number 3, for a young family and business owners, there was no insurance at all, no life insurance at all in place.
Which is all fine as long as things go along without any problem. What happened?
Well, before we could put all the remedies in place for those, the husband had a massive heart attack and died.
Oh no.
Yeah, they left the Susan and the 3 boys to deal with not only the financial but the emotional aspects of what had just happened.
And were they young boys, like young kids at home?
Yes, 2 were under the age of 19, and 1 was 19.
Oh my gosh. So here Susan is dealing with the loss of her spouse, having to take care of the 3 kids, loss of income, who took over the business, like so many questions just spinning around. What was her frame of mind at that point?
Well, her big question was, what do I do now? And so the first thing she did was she took a leave of absence from work to deal with the grief and the reality of things. The next thing that she did was try to deal with the financial aspect of things, and it was a big mess because of the lack of the agreements. She was out of her element. Her husband was the lead in the financial affairs, and so she was struggling with dealing with some of the things that had popped up from.
So it sounds like she was feeling, as one can imagine, very lost, didn't know where to turn, and all of a sudden all these responsibilities have fallen on her. So to catch her breath, she took a bit of time off, but of course that would put her in an even worse financial position. But you got to do what you got to do when life throws you curveballs. So what was her big question for you at that time?
Well, it was, what do I do next?
Well, don't go away. Find out the most important step to plan for the unexpected after the break.
Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. We're here with Franco Papalia, a financial advisor sharing a client's story and why it's important to plan for life's events. Franco, before the break, we were talking about Susan, who lost her husband. He passed away, no will, no buy-sell agreement, 3 kids. Susan wanted to know what to do next. I have to ask you, where did the money go? He had no will, so what happened?
Well, we were able to put some insurance in place before he passed away with the 2 partners, the 2 business partners. So that was very fortuitous.
Yes.
What happened with the business? There was no buy-sell agreement in place. So what happens in a situation like that is the insurance proceeds get paid into the corporate treasury,
Yep.
and they're on the balance sheet. And at that point, the 2 partners own 50-50. So if there was a buy-sell agreement in place, it would have been a different story. 100% of the proceeds would have gone to Susan. In this case, it was a little more complicated. It took a lot longer for Susan to get paid out, and she didn't get the full amount of the insurance proceeds.
So it was very costly for her family to not have been prepared for that event.
Yes, yeah.
Now, not having a will in place, did she then get all of her husband's assets go to her to take care of the kids?
So in British Columbia, the laws are pretty strict on people that don't have wills. So the way it worked in Susan's case, and there's different variations depending on if there's multiple marriages and so on, but in Susan's case, she got the first $300,000 of the estate.
Yep.
Fortunately, the home was in her name. That was for creditor protection because of the
Good.
business, and so the home went to her. But if it had been registered any other way, she would have had to buy it back from the estate.
So she did get some things, but maybe not as much as she could, and it was costly also to sort that out because you'd have to apply to the courts. So Susan's big question for you was, what do I do next? How did you answer that?
Well, one of the things that also happened with the will is the kids, the 3 children, got half the estate, and 2 of them were underage, and so the public trustee ended up controlling those funds. One of the kids was 19 years of age, and he ended up just getting that money outright.
Wow.
And so it created a little bit of stress in the family. The first thing we did was we had a family sit down where I came in and sat down with Susan and the boys. Ended up that the boys, when the boys did turn 19 and the funds were given to them, they realized that Dad's wishes would have been that Mom gets the money, so they did turn the money over to Mom.
Right.
The insurance proceeds, we created another financial plan,
Good.
A new financial plan.
Because that's what Susan was asking for. It's what she needed to move forward is, I know what I've got now, and I need a plan to move forward with my life.
Yeah. So that was a great way to lead her and the family in the new direction.
And I take it she got a will.
She's definitely got a will. Yeah.
And so when something happens to her, her family will be taken care of because she's not going to put them through what she went through. What's your one big piece of advice for investors today and viewers today?
It's pretty simple. Have a plan and execute on it.
Execution is key. Well, Franco, thank you for sharing that story. And stay tuned. Up next, find out why everyone should have a tax-free savings account.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
With us today is Wayne Nikitiuk, a portfolio manager with an interesting career history. Welcome, Wayne.
Thank you very much for having me, Sybil.
tell me about this interesting career history you've had.
Well, I came into the financial industry in 1997, but prior to that, I was a broadcast journalist. So I was quite at home in front of cameras. I spent 7 years in my 20s and early 30s as a journalist at various Western Canadian television stations. So it was a lot of fun
Now,
from the mid-80s to the early 90s.
You must have covered some very interesting things.
I did. Everything from serial killers to meeting the Queen of England. Covered the Gaynors meatpacking strike in '86 in Edmonton, the roller coaster accident that year. I covered a lot of different stories, both national news and local news.
Now, how the shift from that to finance?
Well, it's interesting because while I was in Calgary working at CBC, I met a lot of very successful entrepreneurs, self-accomplished business people and CEOs, and I developed a real interest in business in addition to crime, which was another area of interest. But I decided
not doing crime.
Not doing crime. No, not doing crime. But when they shut down the station, laid off a bunch of people, that was sort of a genesis for another career. So I decided then that I wanted to be self-employed, and the rest is history.
Great. And helping people make the most out of their money.
Absolutely.
Well,
Absolutely.
I want to dive right into a really important topic, I think, for Canadians today, and that is tax-free savings accounts, also known as TFSA for those that want the acronym.
That's right.
Why do you think these are such compelling savings vehicles?
Well, one of the principles of growing your wealth is the power of compounding. So you make a dollar on top of a dollar on top of a dollar. And in investing, consistency is very important because you obviously don't want to lose a lot of money in any one year. The beauty of a TFSA,
I don't ever want to lose.
you don't ever, but sometimes the markets go up and down, so you might see a little bit of that. But when you have a tax-free savings account, the miracle of compounding, as Warren Buffett calls it, is maximized to the biggest extent you can imagine, especially if you've got a 20 or 30-year period to invest if you're young. So that power of compounding you can completely harness in the tax-free account because you pay no taxes on any of the gains or any of the income inside of the TFSA.
So you put your money in. You don't get a deduction, though, for putting it in.
You get no deduction. It's not like an RSP.
Once it's in there, it grows and grows and grows at whatever rate of return you're going to earn on that money. And then when you go to pull it out at the end, guess what? No taxes.
No taxes.
Well, why wouldn't everybody have one of these?
That's a good question. And we know from CRA stats right now in Canada that less than half of Canadians who've got investable assets are taking advantage of TFSAs, and even of those that are taking advantage, only a third are maximizing the TFSA. So I think a few years ago the average contribution room was around, the amount of room that had been actually utilized was about $17,000. But right now, from '09 to where we are today, you could do $52,000. So you can see that people are putting in only about a third of what they could actually put into the TFSA. Which is really unfortunate because I meet a lot of clients that have got money sitting in bank accounts and they could take that money even if they just bought a GIC or something as an interest-bearing investment and they could keep all that interest income. Instead, they're leaving it outside the TFSA and they're paying tax on that full amount.
And that brings me to another question. I know that people get confused by this all the time. They think the TFSA is an investment in itself. It's not.
It's not.
Why don't you explain exactly what it is?
So there's no such thing as an RSP or a TFSA. These are sections in the Income Tax Act of Canada. I think it's section 144 in the Income Tax Act for an RSP. CRA, Canada Revenue, says you can buy a list of investments. Think of the TFSA or the RSP as a box, and you can put different types of investments as long as they're on that long list of approved investments from CRA. So you can put whatever you want in the box.
So
you can buy stocks, bonds, mutual funds, a GIC, whatever you want to put in there. You can be as conservative or as aggressive as you want to be. And the TFSA is your miracle compounding box. There you go.
Oh, I like that. So people who have cash sitting in the sidelines in an investment account, a savings account, there's really absolutely no excuse for them. They need to move that money to the tax-free savings account.
Even if they got a 1.5% a year GIC, right now, interest is taxed at the highest marginal rate in Canada. So why would you pay the highest marginal rate even on a 1.5% or 2% interest rate when you can get all of that interest tax-free and get to keep it all?
Well, maybe just people don't know about it, or it's out of sight, out of mind, but they will know about it now.
Absolutely.
So question for you then. I've got a limited amount of money to invest. I've got a choice. I can put this money into my RSP or my tax-free savings account. Which would you suggest?
That question depends on an individual's personal situation. But I would say in general, if you're a younger person and you've got 20 to 30 years ahead of you and you're not making a really big income, and again, that's open to analysis, the math shows that you're probably better off contributing first to the TFSA.
Yeah.
Because remember, whatever you accumulate also still compounding inside the RSP, but it's tax deferred. So when you take it out of the RSP, you got to pay tax. Yeah. But with the TFSA, it's tax free. So you get the same power compounding, but when you eventually pull it out, whether it's in 5 years, next year, or 10 years from now, it's tax free. And in Canada, being the high tax country it is, we need people to utilize these. This is the best tax-free vehicle for the average Canadian that exists.
And
so I would say in general, depending on your situation, the TFSA would be a better choice.
Yeah, and I say generally, if you're in that tax bracket, gross income's under maybe around $45,000 a year, but you need to see a financial planner, an accountant to make sure.
Work the math out. Yes.
A lot of people totally forget about the impact of taxes when they put it into their RSP. How many people have you seen? They've maximized their RSP, they're retired, and they go to pull the money out and they're shocked at all the taxes they have to pay on that.
So, I mean, there are various tax minimization strategies in retirement, such as, still to some extent income splitting and so on, that you can utilize, but at the end of that period, when you are retired, you've got to pay the tax when you pull it out.
Yeah.
And I think a lot of Canadians now realize that the TFSA, it's been around now since 2009, so it's not a secret.
Yes.
But it absolutely should be utilized along with an RSP. RSPs have their place, don't get me wrong, but the TFSA is a great vehicle, particularly if you're in your 20s or 30s, because you've got so many years that you can allow that wealth to compound and build inside of that account.
Yeah, and a lot of people forget that they can pull the money out before then if they want to.
Correct.
It's like if you pull out of an RSP while you're still working, you're going to pay a higher marginal tax rate because you've already got other income.
Yes.
Talk a little bit about how that works. So if you pull money out of a tax-free savings account, when can you put it back in, or can you put it back in again?
So the rules they're not complicated, but you have to understand the rules. So effectively, the TFSA is highly versatile.
Yeah.
So if you pull money out, you can put it back in within usually that 12-month period. That's the basic rule. And you can keep doing that over and over again if you've got some short-term needs. So the versatility there is you can put back the money you took out, and you can still put in your $5,500 a year, which is the limit right now annually. And it accumulates. So if you miss a year, you can make it up the next year.
Yeah, and that's an important fact for people to know. So if you've missed out, don't worry. All of those back years, you can catch up and put it all in at once. Absolutely. And I know that when you do, if an emergency happens and people need to pull money out, let's say you put in $5,000, it grows to $10,000. You pull $10,000 out of your tax-free savings account, all of a sudden, January of the following year, you can put that $10,000 back in again. So, and there's no penalty.
Nope.
But be careful. Watch for the deposit withdrawal and redeposit rules so you don't get stuck with a penalty.
That's a very good point. So your advisor, the investment firm you're dealing with, should be able to help you track that. But at the end of the day, it actually is your responsibility as the investor to make sure that you don't over-contribute to a TFSA, because then there could be penalties involved. So
check with CRA. They've got that tips line, they've got that online that you can go check out and find out what your limits are. Well, that's fantastic. Thank you for shedding some light on the tax-free savings account. We know that everybody should have one if you have some savings, by the sounds of things. Check for your limits and look at your investment options. There's a whole new world.
The list is very long. Lots of options. Just utilize it.
Wayne, thanks for being on the show.
Pleasure.
When we return, when should you start taking your CPP? Find out next. Welcome back. Thanks for your letters, emails, tweets, and messages. Today's question is from Ruth in Victoria. Dear Sybil, I'm about to turn 65 years old, but I'm still working and love my job. I make good income, over $150,000 per year, so I would like to continue working for a while longer.
I don't have a pension plan, but should have enough in savings and RRSPs to fund my retirement income goal of $60,000 per year until age 100. My question for you is, should I start taking my CPP now or wait until I retire within the next 5 years? Sincerely, Ruth in Victoria.
Thanks for the great question, Ruth. This is one I get all the time. And just to clarify, the CPP stands for Canada Pension Plan. This is a type of pension plan that Canadians contribute money into off of their paychecks so that later in life they do have a retirement income, or at least a piece of it. Now, the Canada Pension Plan was originally designed to start at age 65, and I believe when it was introduced, life expectancy was about 62, but that's a whole other story. In your situation, I think you're better to wait, and I'll tell you why. You're in a high tax bracket today. You're earning $150,000 a year, and you love what you do. If you start taking the CPP now, you're going to pay most of it away in taxes. If you wait until you are 70 or retired before you start taking it, the amount of income you will receive will be higher. It actually increases by 0.7% per month past your 65th birthday that you defer it. Not to mention, you will be in a lower tax bracket, earning only $60,000 a year roughly in retirement. Now, for those people watching who are still younger than that and are wondering if maybe they should take it earlier at age 60, well, if for every month you start taking it earlier, your CPP pension is reduced by 0.6% per month. So you'll want to take that into consideration. So really, a lot of things to think about. Factor in your life expectancy, how many years you're going to live, your current income and tax brackets, and whether you need the money right now or not. So Ruth, because you plan to live to 100, you should end up with a lot more money in your pocket by waiting till age 70. And that wraps up this edition of The Wealthy Life, helping Canadians make smart financial decisions. Join the conversation on social media and tell us your story. Go to thewealthylife.com to ask your financial question to make the most out of what you have.